Welcome to the Explainer. If you've got a smartphone in your pocket or a smartwatch on your wrist, you are already carrying the technology of the invisible giant we're talking about today, and that's Arm Holdings, trading on the NASDAQ under the ticker ARM. We are going to unpack their record-breaking fiscal year 2026 results today, and, well, more importantly, we'll break down a massive strategic shift that could totally redefine their future.
That's right. For investors trying to wrap their heads around the whole semiconductor landscape, Arm is absolutely a foundational piece of that puzzle. But they're also a company going through a really major transition right now. So we're going to objectively look at the mechanics of their business, the recent numbers, and, for sure, the fundamental risks tied to this new strategy.
Okay, so here's our roadmap for today. We're going to start with their origin story. Look at the blueprint business model, dive into those record FYE26 financials, explore their expanding AI markets, unpack what we call the silicon shift, and then wrap it all up with the risk and investor summary. All right, let's jump straight into Section 1, the energy-efficient origin story, or essentially solving the battery life problem. So I'm always curious about this. How does a company that literally powers almost every connected device on the planet actually get its start?
Well, it goes all the way back to 1990. ARM actually started as a joint venture between Acorn Computers, Apple, and VLSI Technology. Their core philosophy, right from day one, was to make processors that were high performance but incredibly power efficient. In the mid-90s, when mobile phones were just starting to gain traction, battery life was the ultimate bottleneck, right? Because ARM's designs sip power while still performing incredibly well, they perfectly capture the mobile revolution. When smartphones really took off in 2007, the demand for that specific balance of performance and battery life just skyrocketed. Fast forward to today, and over 350 billion ARM-based chips have been shipped globally. You probably have, at least 3 of them sitting within arm's reach right now.
Which brings us nicely to Section 2, the blueprint business model, the architect versus the builder. A really common point of confusion for people is what ARM actually sells, right? Because they don't physically manufacture the chips themselves.
Exactly. It's best to think of ARM as the architect, not the builder. They design these incredibly complex blueprints for processors, which is known as intellectual property, or IP. Companies pay an upfront licensing fee just to get access to these blueprints so they can design their own custom chips. Then once that customer, who is the builder in this analogy, actually manufactures and ships a chip based on that design, ARM collects a recurring per-unit royalty fee. It's a phenomenally profitable model because, think about it, a single blueprint can generate a long tail of recurring royalties for years across millions of devices.
Let's see how that translates to the bottom line in Section 3, record FYE26 financial results, the third consecutive year of 20% plus growth. And the top-line growth here is frankly staggering. Total revenue for fiscal year 2026 hit $4.92 billion. That is a 23% jump from the $4.007 billion they reported back in FY25. For a company of this scale, accelerating revenue by nearly $1 billion in just one single year is a massive indicator of underlying demand. Plus, this growth is highly profitable. It generates really strong cash flows that bolster an already formidable cash position, which in turn allows ARM to heavily reinvest in their huge R&D operations. What's really interesting is that both engines of their business are firing at the exact same time. Licensing revenue grew 25% to $2.3 billion. That's driven by multiple high-value agreements as companies are basically rushing to design new chips for these complex AI workloads. Meanwhile, that recurring royalty revenue, it grew 21% to a record $2.6 billion. So this tells us that not only are customers buying new blueprints today, but the chips they designed years ago are still shipping in massive, ever-growing volumes. Okay, let's look at where all this is heading in Section 4, expanding across AI markets, or orchestrating the next decade of compute. We all know ARM totally dominates the smartphone space, right? But with that specific market leveling off globally, they're aggressively pushing into new territories. We're seeing huge growth in Edge AI, which is basically putting intelligence directly into everyday consumer electronics, rather than always having to ping the cloud. They're also expanding in physical AI, powering autonomous vehicles, IoT, and robotics. But the real standout metric from the filings? It's cloud AI. Data center royalties more than doubled year over year. These massive facilities running AI infrastructure are increasingly relying on ARM's power-efficient architecture. They also command about a 50% CPU share among the top hyperscalers. Those are the massive cloud providers essentially running the internet. Companies like AWS and Google are increasingly building custom silicon in-house rather than just buying off-the-shelf chips. For instance, Amazon Web Services uses ARM for its Graviton processors, and Google is actually replacing traditional x86 host processors with custom ARM-based Axion CPUs for its next-generation TPUs. And they do this for one simple reason. ARM gives them the high performance they need without sacrificing energy efficiency, which is absolutely the biggest bottleneck for AI data centers right now. And this leads us to the biggest development, Section 5, the strategic silicon shift, expanding beyond IP. Now, this is arguably the climax of this whole explainer. ARM is making a major pivot. They are moving from just providing blueprints to actually offering production silicon. So what does this actually mean on the ground?
It's a fundamental evolution of the business model. Instead of just handing a customer a blueprint and saying, all right, good luck building this over the next 3 years, ARM is introducing the Arm AGI CPU and Compute Subsystems. Essentially, they're offering pre-integrated, ready-to-deploy, ARM-designed production silicon. This is a direct response to customers who are desperately needing a much faster way to deploy at a massive data center scale, drastically accelerating their time to market.
And the value proposition here is huge. The AGI CPU delivers, quote, more than 2x performance per rack compared with x86-based platforms. Meta is actually their lead partner and co-developer on this. Listen, when you can offer up to $10 billion in capital expenditure savings per gigawatt in the incredibly capital-intensive world of AI data centers, well, the market definitely pays attention. Yeah, and the market is absolutely paying attention. There is already over $2 billion in customer demand for the Arm AGI CPU slated across the next 2 fiscal years alone. That's literally more than double what they initially projected. But, moving from blueprints to physical silicon is a whole new ballgame, which means we really need to look at the other side of the coin. Which brings us to our final parts, Section 6, Risk and Investor Summary, Navigating Valuation and Execution. So with this massive transition underway, what are the actual competitive and execution risks that ARM is facing right now? Right, well, the filings outline some massive execution risk in moving to production silicon. It's a completely different business. But beyond that, they still face fierce competition from traditional x86 architecture, as well as the open-source RISC-V platform. There are also deep macroeconomic and geopolitical risks, especially with their China exposure and the ongoing complexities surrounding their subsidiary, Arm China. Finally, there's the lingering uncertainty of their high-stakes litigation with a major customer, Qualcomm. Plus, they face the risk of alienating other cloud service providers who are currently building their own chips in-house. By releasing their own production silicon, ARM is walking this very fine line between enabling their partners and potentially competing directly with them. And all of this ties directly into the valuation reality. For investors, it is so crucial to separate a great company from a great price. ARM's current valuation has some very, very high growth expectations baked into it, which are intrinsically tied to flawless execution in this AI space. The filings implicitly remind us that any disappointment in this transition or any stumble in execution whatsoever could cause a sharp derating of the stock. It is essentially priced for perfection. All right, to wrap things up, let's quickly summarize the objective investor cases. First, the core reality. ARM has a highly profitable royalty model that is aggressively expanding into AI silicon.
Second, we have the bull case. The Arm AGI CPU executes perfectly, they dominate data center architecture and capture those massive capital expenditure savings. Third is the bear case. Execution stumbles amid global supply constraints, or they end up alienating their key partners.
And fourth, the neutral case. They achieve steady growth, but the high current valuation means the stock simply trades sideways while earnings slowly catch up to the price.
And finally, our fifth point, the crucial disclaimer. This explainer is strictly for educational purposes and is not financial advice. ARM is undoubtedly orchestrating the next decade of compute. But as they step out of the shadows to become the builder, will the market reward their ambition or punish any missteps in execution?
Thank you so much for tuning in, and keep learning.